Hello, and welcome to United Asset Strategies Quarterly Update. My name is Thomas Healy, and with me as usual is Matt DeLorenzo and Jiorden Sanchez. Looking back, the theme of our January video and letter was an expectation for heightened volatility, and we have seen that play out in markets over the last few months. We're going to unpack a lot of the details over the next few minutes, but before I do that, I just want to make an announcement. We're proud to announce that Matt DeLorenzo, in addition to being our Chief Investment Officer, has been named our Chief Executive Officer. So we just want to say congratulations to Matt and his family. And we're excited here at the United family for the future and where we go under Matt's leadership. So with that, I'm going to turn it over to Jiorden with the details.
Thanks, Tom. So moving over to Exhibit 1, it highlights year-to-date performance. Broken down into the first quarter, that's in that gold color, and in the second quarter so far, that's in green. As of the date of the letter, April 22nd, the S&P 500 was down nearly 10% year-to-date. As seen through the NASDAQ, first quarter pressure was concentrated in high multiple, big tech stocks, with the Dow and typical stock holding their value. That said, second quarter pressure has been a bit more broad-based given the global implications of the U.S. tariff policies announced in early April. We're recording this now on April 30th, and the market remains very sensitive to trade negotiations. We aren't out of the woods yet, but in the week since the letter, the S&P has rebounded and is now down just about 5% in hopes of imminent trade deals. Now, shifting over to fixed income, bonds have been a key source of ballast in what has so far been a pretty volatile equity year. This is a pretty welcome change versus the 2022 bear market, with the Bloomberg Ag up year to date. Now, taking a step back, it's important to provide some historical context on this stock market volatility. At its worst, the stock market was down 18% from its peak earlier in the year. And while that level of volatility can be unnerving, as seen in Exhibit 2 on the right, corrections of this sort are quite common, with an average annual drawdown of 15% and declines greater than 15% occurring every 2 to 3 years. Despite this level of volatility, equities have generated attractive 10% annualized returns on average over the long run. So later on, we'll provide more detail on how we're managing through this volatility. But first, I'll turn it back over to Tom to provide some context on the political and economic environment we're investing in.
Thank you, Jiorden. I think an update on fiscal policy is timely because this week marks the 100-day anniversary of the new administration. And what typically happens during the first 100 days is the administration focuses on what we call the candy of fiscal policy. Those things like tax cuts and spending increases, things that are supportive of economic growth and corporate earnings growth. And we saw that in President Biden's first 100 days, where he signed into law the $1.9 trillion American Rescue Plan. However, the Trump administration has taken a different approach, focusing first on what we call the spinach of fiscal policy, things like government employment cuts through the Department of Government Efficiency, DOGE, and also things like tariffs, and not only the implementation of tariffs, but the level of tariffs. What has resulted is a high level of policy uncertainty, and that is really illustrated best in Exhibit 3, where the green line represents the U.S. Economic Policy Uncertainty Index. As you can see, over the recent weeks, particularly since the April 2nd tariff announcement, policy uncertainty has really spiked. And there's a high correlation between that and the CBOE Volatility Index, what we call the VIX, which is in the gold bar. And you can see that's moved up as well in recent weeks in concert with this policy uncertainty. One of the other impacts it's had is it really has impacted the sentiment indicators that we look at. Things like the NFIB Small Business Index, the U.S. Michigan Consumer Sentiment Index. Those things have really fallen off a cliff in recent months, and that has really raised a red flag for economists about GDP growth and corporate earnings. Now, it remains to be seen how it plays out, but the expectation is for the second half of the year, the focus of the administration will be on tax cuts, extending the current taxes, and then reducing them even further, and then the potential for things like deregulation, things that will be a tailwind for the economy and for markets. We could see in Exhibit 4 one of the things that typically happens is after these periods of really high policy uncertainty, we tend to get better results from equity markets over the 3, 6, and 12-month period. Now, as this policy uncertainty unfolds and we get a better sense of what the tariffs will look like and how it affects the economy, we'll get a better feel for markets. But it's not the only factor. Things like the Federal Reserve, what they do with rates and how that impacts bond markets are equally as important. So for that, I'm going to turn it over to our CEO, Matt DeLorenzo.
Thank you, Tom. So one of the big inputs for the Fed, of course, is the path of inflation. And just getting right in here, if you look to the left of this slide, what we've broken out is inflation break even. So basically the market's expectations for inflation as measured by the TIPS market. And we're showing 2-year to get a shorter term view and also 30-year to get a longer term view of inflation. We've pulled the chart back to start at the election to show you how things have unfolded since then. So really what you can see is that the short-term inflation expectations moved higher and also got a lift as the tariffs were announced, whereas the longer-term expectations, they had an initial lift and then they actually moved lower with the tariffs. So really, we can interpret that as the market is seeing the potential for tariffs to have a one-time initial impact to inflation and prices, but not necessarily for that to continue over a longer time period, most likely because of the negative impacts that this will have to longer-term economic growth. So on the fixed income side, we've been pretty active through this. And one of the things that we've purchased throughout some of this turmoil is longer-term TIPS. So that basically correlates to the yellow line that you see on the left side, which is showing a muted longer-term inflation expectation. We felt that that was something that was a value that kind of got shaken out amidst all of this. Shifting over to the right side, another thing that we feel has gotten excessively cheap really in this market is high-quality municipal bonds. So what you're looking at here is the yield of different measures of the Treasury market and also the investment-grade municipal bond market. So generally over this period, you're seeing the rates moving higher, but more recently, the muni market has actually sold off a little bit further, meaning the yields have increased more than the Treasury market. So we're seeing some relative value there. So what we've done is taken the opportunity to extend duration and get our investors a little bit more exposed to longer-term, high-quality municipal bonds, which is really letting them have lock-in tax advantage yield for a longer period of time. So that's a little bit of what we've been doing on the fixed income side, some of the positioning. But to take you through the equity side of things, I'll turn it back over to Jiorden.
Yeah, thanks, Matt. Having warned for the potential of increased volatility in our last letter, we did enter this year conservatively positioned. In addition to holding cash, gold, and having tight stops on a subset of our stocks, many of our strategies favored value stocks versus growth ones to manage valuation risk, and defensive sectors versus cyclical ones to manage earnings risk. As shown in Exhibit 9, these risk-off categories are a good place to hide during periods of high or increasing volatility. So while markets are usually down 1% in those types of months, defensive sectors and value stocks tend to outperform their counterparts by about 1% or so, hedging against some of the broader market declines. But in addition to being defensive, we're also trying to be opportunistic at these times. We note such periods of indiscriminate selling often provide attractive entry points for long-term investors, which is what we are here. So for example, the stock market now trades at about 19 times earnings, down from 22 times earlier in the year, and nearing its long-term average of 16 or 17 times. But perhaps more important, the average stock is now trading below 16 times earnings. Said another way, there are plenty of opportunities to invest within the market at fair valuations. And as highlighted in Exhibit 10, lower valuations do bode well for longer-term returns. At below 16 times for the average stock, as an example, history would suggest returns are usually over 25% 2 years out, with less than a 10% chance of loss. That's a pretty attractive risk reward. So while we remain conservatively positioned and acknowledge the earnings risk that tariffs may represent, no one can pick the bottom. So we've started to invest some of our excess cash in select growth stocks at increasingly attractive valuations in preparation for the eventual removal of uncertainty down the road. So at this point, I'll just turn it back over to Matt to discuss some more of the strategic planning opportunities available in the current market environment.
Thanks, Jiorden. While market corrections can be uncomfortable, we note that they offer strategic planning opportunities for clients. As we typically do when we see these opportunities, we've been executing tax swaps, really harvesting losses to offset future gains, and really in an attempt to minimize our clients' tax bills. But we'd also like to point out that down markets can also offer improved opportunities for gifting and Roth conversions as well. So if you'd like to discuss any of this in more detail, please feel free to reach out to your Knight financial advisor for a deeper conversation. And with that, we'll close it out. Thank you for listening, and we'll see you next quarter.